Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is Tuesday, January 23rd. Today we're going to take a look at one out of the consumer discretionary sector, DR Horton, America's builder. This is the largest builder in America. Let's jump right in and take a look. And if you are new to the channel or you would just like to help grow the channel and get the word out that dividend growth investing, in my opinion, is the best way to financial freedom, go ahead and hit that thumbs up button down below. Hit that subscribe button and hit that notification bell so you're notified whenever we put out any new content. Join us on our journey to financial freedom. Join the Vested Interest community. Hopefully you are on your own journey as well. This is the Vested Interest stock screener. This is how I set up the videos. It's also how I look at a company on a high level to see if I am interested in investing. If it meets the criteria, 5 of 8. If it's not a bank, if it's a bank, I throw in price to book. Then it goes on my watch list. And I do more of a deep dive into the financials, look at the balance sheet, the income statement, do a discounted cash flow analysis of it, and I try to buy it when it hits within 15% of its 52-week low. You can pause this and go through my screener. Don't just blindly copy my screener. I'm just a random guy on YouTube. I do not have a background in this. I do not have a degree or education in finance. I do have a degree. I have a bachelor's degree, but it is not in finance. I'm an old construction guy. My dad was a mason, so I started working in construction whenever I was about 12 years old. At least that's whenever I started getting paid for it. So I've been doing that, and these type of companies I am familiar with, but that does not make me an expert. And never blindly follow anyone that you're watching on YouTube. Make sure you are doing your own due diligence. And for some of you who don't want to do the research of individual stocks, ETFs or index funds are probably a better choice. And let's keep going here. Now, if you want to know more about this company, check them out at www.drhorton.com. That is www.drhorton.com. That is their homepage where I pull this information from. In 1978, DR Horton broke ground on our first home in Fort Worth, Texas. Over here is their founder, Donald R. Horton. Since that day, the company has defined its success not by bricks and mortar, but by satisfaction of the families that make our houses their homes. Our foundation is a single guiding principle, a value-first dedication to the individual needs of each and every one of our nation's home buyers. From first-time home buyers to empty nesters, DR Horton provides a home from every stage of life. Our highly trained market experts are where you want to live, from New Jersey, Hawaii, providing unique personalized services tailored to your individual needs. You can read the rest. They are America's #1 home builder, and they are all across the country, right? They really focus on the American market. And again, if you want to know more about them, www.drhorton.com. Now, the reason we're taking a look at them, down 9.24% on the day. Not as big of a drop as we saw yesterday, but still pretty close to 10% here. Anytime you see a drop that big, I'm going to take a look at it. We are talking about DR Horton Inc, ticker DHI, out of the consumer discretionary sector. Closed out the day at $143.13. 52-week range as low as $89.05, as high as $157.93. They are definitely closer, even with the drop today, to their 52-week high than their 52-week low. Average volume 2.5 million. Today's was 11 million. Big drop on the day, even though it doesn't look big. And a lot of people piling out of this one, jumping out of this one. Market cap of $47.662 billion. A beta of 1.63, so it is much more volatile than the overall market. You may be able to use that to your advantage. That's always a good sign. If you're looking to get into a company, you may be able to find that volatility and find the weakness whenever it drops down and be able to pick it up cheaper. So don't be worried about the beta. I like a lot of low beta companies in my portfolio, but don't be dissuaded from buying some of the higher beta companies because, like I said, you can use that to your advantage. Even though you might see some swings from highs to lows, you can use those lows as your buy and entry points. Price to earnings PE ratio sitting at $10.36. That seems low, but for this industry, overall, they actually have a low PE. So make sure you're comparing companies to other companies in their sector. Don't just go by, oh, it's a low PE, I'm going to invest. One of the rare times we're going to see the earnings per share, EPS, higher than the price to earnings ratio, and the EPS is $13.81 per share. Earnings date was today. They did have bad earnings. You want to take a look at that if you are interested. I did do a little bit of research on this one before I jumped into the video today, and their earnings was a mixed bag. They did not hit the earnings that they were expected, so that is part of the reason for this drop. And it actually, I don't know if other companies had their earnings today, but if you looked at the builders overall, they're all down today. Forward dividend is $1.20 and with a very low yield on this one, 0.76%. This is much lower than the yield I typically like, but would not be a bad starting yield if it's in line with their dividend yield theory and showing some value. For those of you who are younger investors, don't be afraid of the lower yield. And if it's paired with high growth, that actually could be a very good compounder. But this is typically lower. I'm in my mid 40s. So for me, I would want much more of a pullback to bring this yield up on this one. Ex-dividend date was November 20th. They paid out on November 28th. So you should have another dividend coming up here. Probably the ex-dividend date would be next month with a payout next month as well. Or March possibly. 1 year target estimate of $157. So they do see it going back up close to its 52-week high, but not any higher than that. So maybe, like I said, maybe able to use this beta, the volatility here to your advantage on this one. They may be starting to head south after they hit their 52-week high. You never know, though. It could skyrocket tomorrow. That's just the way stocks are. Now, I'd like to get into the statistics, look at dividend yield theory. To do that, you'd go to Yahoo Finance, where I pulled this information from, not affiliated, just one of the sources that I like. You'd click on statistics. You'd go down to dividends and splits. You'd look at their 5-year dividend yield average, 1.06. You compare it to its current, 0.76. And since it is lower than their 5-year average, and over here, 0.76, they're the same. Forward annual dividend and the current dividend are the same. Since it is lower, it speaks to overvaluation on this one. So according to dividend yield theory, this one needs to pull back more. Even though it was at 9% pull back today, it needs to pull back more, and I would like more of a margin of safety. If it got to 1.06, that would just mean fair value according to dividend yield theory. So it would need to be in the 1.15, 1.2 range for me to really be interested in this one. But again, very low, very, very low payout ratio, 7.24%. So even though it has a low starting dividend yield and we'd want it above 1.06, I would anyway, the payout ratio is very low. So they have a lot of runway to increase this dividend yield over time. And hopefully, we'll see that in a minute, they are increasing it at a rapid pace. Now, you want to get into the financials. If you're going to be investing in individual companies, you need to understand the financials. You need to know how to read a balance sheet. You need to know how to look at an income statement. You need to know how to look at revenue. Is it growing? Are their margins growing or declining? Are they paying down debt? What does their free cash flow look at? We're going to look at free cash flow because we want growing free cash flow. You can assets over liabilities. You know, a lot of good information here. Are they taking on debt? Are they paying down debt? A lot of good information under financials you should be looking at if you are investing in individual companies. We're going to look at free cash flow. We want growing free cash flow. That's what dividends are paid out of. And typically, if a company has growing free cash flow, they have growing dividends over time. So going back to 2020 here, they were at $1.1 billion. 2021, big drop down, 267 million. 2022, big jump up to 413 million, and huge jump here last year in 2023, up to 4.1 billion. So overall, from 2020, they do have growing free cash flow. And even though these 2 years in the middle, 2021, 2022, look like they had huge drops, look at this repurchase of capital stock. They went from 398,000 to 929,000, so 3 times the amount of repurchase of stocks, and even more in 2022, and even more in 2023. So even though you saw a bit of a decline in 2021 and 2022, it looks like it is offset by the repurchase of shares. And then just 2023, they've had a banner year. It's just a huge jump up in their free cash flow on that. So I like this overall, definitely growing free cash flow. I'm not saying that's going to continue into the future, but this is a good sign. Now, I always recommend more than one source. So another one that I like is stockanalysis.com. And of the 15 analysts that they've had take a look at this, they call it a consensus buy. They have a low estimate of $115. Now, remember that volatility we were talking about earlier, maybe it goes back down to that 115, and that's a better buying price, right? At least close to that. That's what I'd be looking for. Personally, I'd be into this one probably under $120 is where I'd like. So definitely 115 would be a buy for me. I do like this company, and that would be a 19.65% decrease from where it currently sits. Have an average estimate of $141.07. That would be a negative 1.44% from where it sits. So they definitely see this one coming down still. That's what I'm seeing here. If even their average estimate is lower than where it currently sits, they see that this one needs to drop some more. And they have a high estimate of 173, which would be a 20.87% increase from where it currently sits. All the while, you could collect that 0.76% dividend yield. Now, I like to get into statistics here and look to see how a company is doing financially. their financial efficiency, how they're reinvesting their capital. To do that, we're going to look at return on equity, ROE. That sits at 22.3%. I like 10% or better, so this meets that metric for me. I look at return on invested capital. I like 10% or better there as well. That 16.63% beats that metric I'm looking for. I also look at earnings per share growth forecasted over the next 5 years. I like 5% or better. This is sitting at 6.54, so that meets that metric for me. And revenue growth, I always throw in at 4.93%, though it's not really a metric I look at. I do want growing revenue, though. You do want growing revenue over time. But this is not a deal breaker. Sometimes companies, especially if they're cyclical, they might go through times where they have decreasing revenue or flat revenue, and that's all right. So long as their earnings per share and the rest of their metrics are good, I can forego a little bit of revenue growth, especially on a company that's cyclical. And these type of companies are cyclical. Builders are cyclical. Now, as we saw earlier, we're going to look at the dividends here. Payout ratio very low. They're saying 8.68% here. I think they said 7 point something on the previous on Yahoo Finance. Again, that's why I look at more than one source. Stockanalysis.com is this source. Make sure you're picking more than one source so you can make sure the information you are getting is accurate and up to date. Very fast dividend growth on this one, 13.51%. So very low payout ratio, very fast dividend growth, very low payout overall. But I like that paired. If it's going to have a low payout ratio and a low dividend yield, I want high growth, and you should too. Going back to 2020, they were paying 20 cents. They raised it up December 2021 up to 22 cents. Raised it again December 2022 up to 25 cents. And then most recently in November of 2023, they raised it up to 30 cents. So very nice dividend growth overall. Even though it is a low payer, you could possibly use that volatility that we saw on the first slide from Yahoo Finance to your advantage and try to get this one cheaper with above, I would say a 1.2 dividend yield would be where I'd be interested in this one. I do like the company. It is on my watch list. I just want more of a pullback. Well, that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel down below. Help me grow this channel. It really does help a small YouTube channel like me if you do all of that. And drop a comment down below. Let me know what you think of the video. Join us on this journey to financial freedom. Join the vested interest community. Again, hopefully you're on your own journey as well. And if you have not started your investing journey, let me know why not in the comment section down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you would like me to cover in the Stock Pick of the Day series, go ahead and drop down below. And for those of you who have made suggestions, I really appreciate it. I will get to them over time. I have a lot of them on my list right now. There are just other companies that I have in front of them. So please be patient. I will get to them at some point. Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and money. Should never invest any amount not comfortable losing. Always do your own research. Must based on your situation, circumstances, and select criteria, or seek the advice of a certified financial advisor.